Maintaining a dividend payout for half a century requires a staggering, uninterrupted flow of cash. But to qualify for the elite title of a dividend king, a company must actually increase that payout every single year, regardless of recessions, inflation, or market crashes. Abbott Laboratories is one of these rare giants. It has reliably bumped up its quarterly dividend for over 50 years, earning a reputation on Wall Street as a cornerstone of defensive investing. But right now, that historic streak is facing a severe stress test. The immediate threat is the disappearance of a massive revenue windfall. During the peak of the pandemic, Abbott pulled in billions from rapid testing, a cash fire hose that has now completely dried up, leaving a massive vacuum in their quarterly earnings. To survive the slump, Abbott chose an aggressive offensive strategy. In the first quarter of 2026, they finalized a $3 billion acquisition of Exact Sciences. This massive purchase is designed to replace that lost testing revenue by actively mutating the company's core product lineup. They are buying their way into entirely new, high-margin healthcare markets. Figuring out whether a $3 billion gamble will save or sink a 50-year dividend streak requires us to completely deconstruct Abbott's current revenue model. Abbott's $11.16 billion Q1 revenue flows through four pillars. Established pharma delivered 9% growth, bringing in $1.43 billion. Nutrition brought in $2.02 billion, down 7.7% following 2025 price reductions. But nutrition faces a major legal overhang. There are over 700 active lawsuits related to NYSE in connection with its infant formula. These legal costs will be a persistent drain on the company's valuation throughout the year. Then there's the diagnostics pillar. For a few years, this was the undisputed cash cow, churning out massive profits on the back of global viral testing mandates. Without those mandates, molecular diagnostics dropped by 10% this quarter. The division is now entirely exposed to the unpredictability of seasonal virus cycles, and a weak respiratory season means weak earnings. Nearly half of Abbott's traditional business is currently bogged down by seasonal unpredictability and prolonged legal battles. A structural pivot was required to keep the overall business growing. The weight of those struggling divisions is being offset by Abbott's primary growth engine, medical devices. This segment alone generated $5.54 billion in the first quarter. That growth is heavily driven by the absolute market dominance of the Freestyle Libre 3 continuous glucose monitor. This single product line pulls in $2 billion every quarter. Abbott is now expanding this technology past diabetic patients and into the broader consumer market. Their new Lingo biowearable targets non-diabetics, allowing everyday consumers to track their metabolic health and optimize their diets. However, this aggressive expansion invites regulatory scrutiny. Recent FDA updates highlighted 860 serious injury reports linked to the Libre 3 sensors, creating a reputational risk that could slow down broader consumer adoption. Knowing they couldn't rely solely on medical devices, Abbott looked back at their shrinking diagnostics segment. This is where the $3 billion Exact Sciences acquisition comes into play. If we look at this updated structural model, the acquisition effectively builds a massive, high-margin fifth pillar for the company, dedicated entirely to oncology. By absorbing products like the Cologuard screening test, Abbott immediately triggered a 13% spike in their cancer diagnostics revenue. They are intentionally shifting their core products away from volatile, low-margin viral testing and replacing them with stable, high-margin metabolic and oncology trackers. Rebuilding a corporate structure in real time comes with immediate financial penalties. Integrating Exact Sciences is projected to dilute Abbott's 2026 earnings per share by 20 cents. Management expects that short-term drag to clear quickly. They are projecting a comparable sales acceleration of 6.5% to 7.5% by the second half of 2026 as the new oncology assets mature. Because of this deliberate transition, analysts widely rate the stock as a core defensive buy. Many financial models place its fair value significantly higher than its post-earnings trading range of $91 to $93. As a reminder, we are exploring this for informational purposes only. This is not financial advice, and you should always do your own due diligence before making investment decisions. Abbott's current blueprint demonstrates how legacy conglomerates survive major macroeconomic shifts. Rather than stubbornly defending outdated revenue streams, they cannibalized their own lagging segments to aggressively fund the innovations that will drive their next decade.